gentlemen, you are connected for the Rishabh Instruments conference call. Please stay connected. The conference will begin shortly. Participants, you are connected for the Rishabh Instruments con call. Please stay connected. The conference will begin shortly. Thank you.
Ladies and gentlemen, good day and welcome to Rishabh Instruments Limited Q3 FY25 earnings conference call hosted by DAM Capital Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you and over to you, ma'am.
Yeah, hi. Good evening, everyone. Welcome to the Q3 FY25 earnings call of Rishabh Instruments. We have the management today being represented by Mr. Dinesh Muslikar, Full-Time Director, Mr. Vishal Kulkarni, CFO, and Mr. Anand Lada, Finance Director, UML. At this point, I'll hand over the floor to Mr. Muslikar for his initial remarks, post which we'll open up the floor for Q&A. Thank you and over to you, sir.
Yeah. Thank you, Bhumika. Welcome and good evening, everyone. Thank you for joining us on Rishabh Instruments Limited Q3 and 9 months FY25 earnings conference call. Along with me on the call, I have Mr. Vishal Kulkarni, our CFO, Mr. Anand Lada, Finance Director, UML, and our Investment Relations Advisor, SGA. We have uploaded the Q3 FY25 results and investors presentation on the stock exchanges already. And I hope some of you at least must have had a chance to go through the same. If not, I would request you to go through the same after this call. I am happy to state that we have achieved a consolidated revenue of rupees 1,812 million in Q3 FY25, registering a growth of 13.7% on year-on-year basis. And 9 months FY25, we have achieved revenue of 5,329 million, registering a modest growth of 4.1% on year-on-year basis. This calendar year has been a challenging journey for us at Rishabh Instruments, particularly within the Lumel Alucast business. We encountered several hurdles, including the economic downturn in Europe, rising power costs, increased manpower expenses, and higher raw material prices. Compounding these issues, we were tied to older contracts that were signed pre-COVID, a time when market conditions and costs were vastly different. Despite booking some losses, we managed to navigate these difficulties by renegotiating and changing the terms of these contracts. This was not a small feat, given the significant surge in costs post-COVID and post-Russian-Ukraine war. Fortunately, our patience, resilience, and strategic adjustments helped us steer through these turbulent times. In our Alucast aluminum die-casting business, performance remained relatively flat on the year-on-year basis. Lumel Alucast reported a modest growth of 6% year-on-year Q3 FY25, while its performance for the first 9 months of FY25 remained unchanged compared to the same period FY24. The challenges stemming from the automotive industries over the past few quarters are now showing signs of stabilization. Notably, Q3 FY25, we successfully spinned off our EBITDA margins by 1,000 basis points. On a quarter-to-quarter basis, reaching minus 3.7% compared to minus 14% in Q2 FY25. I just want to repeat this sentence because we spoke about that in our previous calls also. We had all the challenges, but the last quarter we have seen a reverse trend already happening. Our EBITDAs from minus 14% dropped to minus 3%. So that's a large improvement we made in plugging those bleeding which was already happening in our Lumel Alucast business. This significant improvement was driven by our persistent efforts to renegotiate contracts with key customers and implement stringent cost control measures. We are optimistic that the worst is behind us and believe we are on the right path to transforming the Alucast business in the coming quarters. Our goal is to achieve break-even at EBITDA level, marking a critical milestone in our turnaround strategy in the next 1 or 2 quarters. On the positive side, our electronics business at Lumel SA Poland and Rishabh India have been gaining strong momentum driven by growing commitment to industrial automation and global shift towards clean energy sources. Lumel SA achieved a remarkable year-on-year growth of over 19% in its 9 months FY25 top line, while Rishabh domestic business in India saw an impressive expansion of 19% year-on-year. We are actively strengthening our capabilities in domestic market and building a robust team to support and sustain the growth journey. We are witnessing an increasing demand in the electronic business both in India, Lumel, SA and domestic markets on back of our expertise in providing value-added services across automation and turnkey projects. The electrical automation industry is rapidly growing in some of the European nations and has been instrumental to gain additional market shares. The top line of Rishabh electronics business in India also experienced a growth of 31% and 3% year-on-year, both on a quarterly and 9-monthly basis respectively. Though here we are witnessed export being slowed during the quarter, primarily attributed to weaker demands in Spain and Germany. Additionally, Q3 historically been a weaker period for exports due to holidays in international markets. Despite these challenges, we remain focused and adapting to market dynamics and driving long-term growth. Our electronics business aims to provide comprehensive solution to clients who look for environmental friendly and cost-effective ways to measure, control, record, analyze and optimize energy and processes. And has generated above par growth primarily in Lumel SA. The electronics business has achieved a steady and stable EBITDA margin of approximately 17 to 18%. Q3 FY25 is cyclically weak quarter for exports due to prolonged holiday seasons in international markets. Even during this soft quarter, our revenue remained flat on a quarter-over-quarter basis as compared to Q2 FY25, which is normally a superior quarter compared to others. Further, our focus on cost optimization initiatives in Q3 FY25 and strategic contract renewal enabled us to achieve a remarkable 200% growth in EBITDA on a quarter-to-quarter basis. Our profit after tax has surged by 225% over the previous quarter, underscoring the effectiveness of our efficiency measures and operational resilience. These results reflect our commitment to driving profitability and optimizing our business model despite external challenges. Further, our expansion in our existing facility at Lumel SA will enable us to better meet the production requirements of global customers while significantly reducing delivery times. The growing number of inquiries and orders of our products is a testament of superior quality and reliability and adherence to stringent norms. Furthermore, for certain countries, the Made in Europe label is mandatory requirement. By complying these standards, we are further solidifying our market presence and strength in the European region. In another proud achievement, Lumel SA has been honored with 3 prestigious awards in the last few months that we have received. First one is Forbes Magazine Diamond 2025 Award, a symbol of financial excellence and innovation. This award recognizes organizations that have demonstrated significant revenue growth, financial resilience, and exceptional management practices over the last 3 years. So this award is given to the top 50 small and medium scale companies in the entire Poland as a country, and we listed as one of the company there. Second significant award we received for Lumel SA is Business Gazeta 2024, 3 years of consistent market growth. The Gazeta Business 2024 title by Plus Business, a prestigious distinction awarded to companies that have maintained dynamic growth over the past 3 years as one of the Poland's most respected ranking for small and medium-sized enterprises. This award is based on objective financial criteria, ensuring transparency and credibility. This is similar to ET awards in India. Innovation Award from the Marshal of Lubuskia Voivodeship. This is like a state in Poland country named Lubuskia, and this is a government award. Lumel has secured first place in the innovation category for medium-sized enterprises in the Lubuskia Voivodeship region, presented by the Marshal of Lubuskia Voivodeship. Marshal is equivalent to Chief Minister there. This award recognizes Lumel's ongoing commitment to research and development, technological progress, and innovation-led market leadership. These accolades reflect our strategic focus and unwavering commitment to technology, sustainability, and financial strength. Our outstanding results we have achieved validate our approach and underscore our dedication of excellence. Our commitment to technology, sustainability, financial strength have yielded outstanding results, and these distinctions validate our approach. We are proud of our team, whose unwavering dedication and expertise have enabled us to achieve these milestones. These awards strengthen our long-term vision and inspire us to achieve even greater success in future. These accolades reaffirm Lumel's sustained market leadership and operational excellence. As we move forward, we remain focused on driving revenue growth, enhancing shareholder value, and advancing technological innovation that will shape the future of our industry. We extend our sincere gratitude to our employees, investors, and partners for their continued support on this transformative journey. Moving forward towards our solar string inverter business, which is gaining good traction, we saw a growth of 35% in this quarter. We have also appointed a new team lead to scale our solar inverter business. He comes with 13 plus years of experience in various companies like Fimer, ABB, SMA. Solar inverter segment revenue has increased by 28% on year-on-year basis for 9 months FY25. This business is steadily gaining momentum with increased efforts of cost optimization already in place. We also plan to develop and launch new generation of Neo, a 3-phase inverter, and Uno, which is a single-phase inverter, to align the products to various government solar schemes announced to remain competitive in Indian market. Let's talk about the update on CapEx and R&D measures taken during the quarter and other key highlights that happened during this quarter. On CapEx front, we are further expanding our electronics manufacturing capacity by adding the state-of-the-art new SMT, surface mount technology, lines both at Rishabh, India and Lumel SA, Poland by end of this financial year, which will support growth in our electronics products, EMS and solar production. The construction work of our Nashik facility is shaping up very well and on time. This new 6-story buildings, 2 of them, will double our capacity across all core segments in the electronics and instrumentation business. This is expected to be completed before end of next financial year. For the past, we have consistently invested in our R&D initiatives. Our China subsidiary, V&A, which presents promising opportunities for new product development, recently designed and developed a 100 amps direct current energy meter, making a significant milestone. Our R&D efforts are ongoing and we will share further updates as our plans progress. We are confident that these investments will yield strong returns in the future. We have successfully UL certified the large range of current transformers manufactured in Rishabh Instruments and very high-end power quality analyzers ND45, which is manufactured in Poland. This opens our doors to American markets because to sell these products in America, we need to have UL certification, which is very stringent, and we have gone through this process. And we will be adding more and more products to this UL certification to open the market in US substantially in the coming months and years. We have about 15 products in the pipeline to be added by financial year 26. We target to achieve about 10% incremental revenue from the new products launched in the last 2 years. We also actively invest about 2% of our revenues in our R&D facilities to innovate, design, develop new products in-house. Lastly, I am thankful to our entire team of Rishabh Instruments, Lumel, V&A, Sifam Tinsley, who have constantly supported us in our ambition to become the leading global energy efficiency solution company. With this, I would like to hand over to Mr. Vishal Kulkarni, our CFO, to delve upon financial performance of the groups. Thank you. Over to you, Vishal.
Thank you, sir. Good evening to everyone. Our Q3 FY25 consolidated revenue stood at rupees 1,812 million, showing a growth by 13.7% on a year-on-year basis. The 9-month FY25 consolidated revenue stood at rupees 5,329 million, registering a modest growth of 4.1% on a year-on-year basis. The consolidated adjusted EBITDA remained at rupees 172 million in Q3 FY25, up by 70.9% on year-on-year basis, and for 9-month FY25, the consolidated adjusted EBITDA remained at rupees 418 million, which is down by 43.6% on year-on-year basis. The consolidated adjusted EBITDA margin stood at 9.5% in Q3 FY25, whereas it is 7.9% in 9-month FY25. The consolidated PBT stood at rupees 109 million in Q3 FY25 and rupees 211 million in 9-month FY25. The ESOP expenses for 9-month FY25 stood at rupees 96 million, and we expect another rupees 19 million to be booked in FY25. Now I will go through you the company-wide key financial highlights. Rishabh India. The standalone revenue for Q3 FY25 stood at rupees 592 million, which is up by 29.3% from Q3 FY24. The 9-month FY25 standalone revenue stood at rupees 1,708 million, which is up by 3.2% from 9-month FY24. The standalone adjusted EBITDA stood at rupees 73 million for Q3 FY25, down by 3.5% on year-on-year basis. For 9 months, FY25 stood at rupees 254 million, down by 31.9% from 9 months FY24. The standalone adjusted EBITDA margin remained at 12.3% for quarter 3 FY25 and remained at 14.8% in 9 months FY25. Lumel SA, our electronics business in Poland, has achieved the revenue of rupees 515 million in quarter 3 FY25, up by 4.7% on year-on-year basis, and achieve a revenue of INR 1,570 million in 9 months FY25, up by 19.3% on year-on-year basis. The adjusted EBITDA stands at rupees 111 million for Q3 FY25, up by 19.5% on year. For 9 months FY25, adjusted EBITDA stood at rupees 309 million, up by 13.9% on year-on-year basis. The adjusted EBITDA margin stood at 21.5% in Q3 FY25 and at 19.7% in 9 months FY25. Lumel Alucast, our aluminium die casting business in Poland, has shown a growth of 5.8% in revenues in Q3 FY25 and remain INR 632 million. The 9-month FY25 revenues stood at rupees 1,910 million, showing modest growth of 2.1%. The adjusted EBITDA stands at negative 23 million in Q3 FY25 and negative 151 million in 9 months FY25. All other companies in UK, USA and China have grown by 3%, 33% and 24% respectively in revenues, and have contributed an EBITDA of rupees 3.4 million to the consolidated financials. On the consolidated level, we remain net debt free with a strong balance sheet. Net cash and cash equivalents as on 31st December 2024 stand at rupees 776 million. The company remains net debt free as on 31st December 2024. With this, I shall now leave the floor open for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, before we begin with the Q&A session, I would like to read out a small disclaimer. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance of the company and may involve risks and uncertainties that are difficult to predict. Thank you. Participants, you may press star and 1 to ask a question. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Ravi Shah from Versus Capital Advisors. Please go ahead.
Hi, sir. Am I audible?
Yeah.
Yes, go ahead.
Yeah. First of all, sir, congratulations on receiving awards at Lumel SA. And sir, my question will be, how was the electronics business performed during the quarter? And is this one-time growth due to any order, or do you see this growth of sustainable 15-20% for this segment going forward?
Okay. Ravi Shankar, thanks for your wishes. And if you look at electronics business, it has been very stable and consistent. And if you look at our historical track record also, Lumel SA, these awards which we got, we have got 20% approximate year-on-year growth for last 3 years in a row. That's why we got those awards. And if you look at Rishabh electronics business also, a similar growth is there, about 15 to 18%. So this year in Rishabh electronics business, if I look at the domestic sales, Rishabh electronics business, we have got 2 parts. One is 50% of the sales happen in India, which we have got 19%. So this is sustainable, and we have been having that number last 3-4 years continuously. The export business last year was a one-time high last year. So we had a very huge growth of Rishabh export business, which did not, there was a decline because that was a project order. So now we see again it going back, and if we have to offset that, otherwise we have this steady growth of anywhere between 17 to 20% for electronics, and with the EBITDA of anywhere between 17 to 20% based on different entities we have. That's very much sustainable, and our track record also shows that, and we have absolutely no doubts on that. So all those turbulence which we had were basically coming out of Lumel Alucast business. And Lumel Rishabh export this year in the first 2 quarters was, I would say it was low compared to last year. But last year in the last financial year, first 2 quarters we had some big project orders. That's why that difference was looking. But those kind of orders have also started coming back now. So we don't see much of a problem on the electronic side of the business at all.
Understood, sir. Thank you for such a detailed answer. I just had another question on the auto side and non-auto business for Lumel Alucast. So are the pressures persistent over there, or have we successfully turned it around at an EBITDA level? I just wanted some understanding there.
Yeah. That's really, I was expecting that question, and it's a very important question that we were asking ourselves in the company also. And as a shareholders, you have a full right to ask that question. See, if you look at, I'll give you a little bit of a bigger landscape, and then we come to our company. If you look at European auto industry, which is in a big turbulence. I mean, you will hear about a lot of even companies like Volkswagen, and many companies are closing down, or the revenues have dropped substantially, or they have losses, etc. So the environment is challenging there, and that challenge is coming because of EV car revolution which is happening in this industry. And unfortunately, in the EV industry, Chinese are about a decade ahead of Europeans. This is a fact, whether somebody accepts or not. So now there is a lot of pressure from the governments to come up with the EV cars at a price which is competitive with Chinese, which is a challenge, which has created all this disturbance in the whole industry. Because the government is putting a lot of pressure on the carbon footprints. On the other side, the technology in Europe is not good enough to produce cars with that effectively or competitive to Chinese cars. So we are in that supply chain, and unfortunately, when we entered into these contracts, we are really proud because we are getting into cutting-edge technology on the EV cars, etc. That has kind of little bit backfired to all the people who were involved in these projects. So what we have done now is we went back to these big customers and talk to them. Yes, look at this situation that we have. We signed this contract, but we are not making any money. This is not going in a good direction. So we have to renegotiate the terms and we have to renegotiate the prices. Of course, they have commitment to their suppliers, and it's all watertight, very stringent agreements that we have. And we had to relook, and we renegotiated with our customers to limit our losses and also to get a price increase. So effectively, with all the automotive customers, with all this price increase, we have been effectively able to get some price increase in this year and also continuing in the next year. But also some of the contracts we mutually agreed that we will discontinue them until they relocate this project. Some of them are getting relocated to China because of the cost pressure, and we'll supply them until such time, but not at the price at which we have signed the contract. But we want to have a price which we negotiated. We will, with the increased price, we'll supply until such time. Some of these contracts will get over in 3 months, 4 months, 9 months, something like that. So about 1 year, this will be going out. So if you see the drop in Lumel Alucast sales, 2% drop is it. This is engineered. We wanted this drop to increase our profits. At the same time, we are more active on the non-automotive side, and we are increasing that. So if you look at our whole in the group also portfolio, we used to be close to 40% aluminum die casting business, which has dropped to 35-36%. So that's a shift. That's a conscious shift which we have made, and most of that drop within that is happening through aluminum automotive industry. So we have spun the whole thing. So it's a matter of next few quarters that these projects will get to zero profit or some positive profit. On the other side, we will start developing more with the non-automotive business, and we are confident that we will get back the EBITDA level to positive double digit in a few quarters time. It's not going to happen very quickly because of long gestation period and contractual commitment. But the good thing is that we already hit the bottom, and we have started our course going up. So that's the thing which I want to say, and that's what we have put in our presentations, which are uploaded on the stock exchange also.
Understood, sir. Thank you again for the detailed answer. So I was going to ask about the non-auto business only. You only mentioned about it. So my last question would be, are there any expansion plans for the EMS business within Lumel Auto Parts? That's my last question, sir. Thank you.
Yeah. So for EMS expansion, we have plans in Rishabh as well as in Lumel SA. In fact, in Rishabh, we recently invested 8 crores to have a new state-of-the-art SMT line. This entire SMT line increases our surface mount technology, which is used for making the PCBs for computers or any electronic devices. That has increased. See, we count something which is called as a CPH, the components per hour. We have got 2 lines. Those 2 lines together, we have close to 195,000 CPH. Now this new line alone has got 185,000 CPH. That means our new line, which is state of the art, which is installed, which has a clean room and meets all the requirements of electronic manufacturing, has already been more than double the capacity. So this is what we did, and next year the budget will be focusing more on EMS business in India, which is a big thing. And in Lumel also, we have 3 SMT lines. 4th one will be up and running by end of this year. That is also going to give 1 dedicated line for EMS business. To answer your question, yes, that's a focused business for us, and we are making expansions into that, and that will be having effect in the next financial year.
Understood, sir. Thank you so much, and all the best, sir.
Yeah, thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Rohan Vora from Envision Capital. Please go ahead.
Hello, sir. Thank you for the opportunity and congratulations on the numbers. So, sir, the first question was on the electrical automation business. So, now we've hit 36 crore top line this quarter, and you said that half of it is generally exports, and that was weak last quarter. So anything that has changed on the export part was my first question. Thank you.
Yeah, this quarter from Rishabh exports, there is a uptrend, so that has some effect, I would say. And the next quarter also, we are expecting the trend to be going, and we are also working on a big project pipeline from many customers in the export market, where we have to modify some of our products and develop some products for them. So that's all on the horizon. So we feel that the export business is going to increase.
And sir, which end user industries or which countries would these be on the export side for electrical automation business?
Yeah, on the electrical automation business, we have strong footprints in the whole European continent, particularly in Germany, Spain, from Rishabh, and from Lumel, we have a whole European footprint. That's one big market for us. Second big market for us is Middle East. Middle East is another big region for us. Southeast Asia is moderate. Americas and African markets are moderate, I would say. Trans-Asia is also moderate, but our two big markets are Middle East and Europe. But we see huge opportunity in US market, and to sell the products in US, we have to go through UL certification of all your products that I covered in my presentation also. We are doing that. That is a big investment. Every time your product has to go through UL certification, which is expensive affair, and then we can sell much bigger. We have an office there. We supply from Rishabh factory and Lumel factory, and we have this brand also, STI, and under that brand we supply there. And we have plans to grow that market substantially. This we see as a big opportunity for us to sell in US market. That's a market which we have under focus. And then Southeast Asia is another market which we are looking at to expand.
Got it, sir. And sir, the second question was on the auto side of the aluminum die casting business. So we said we are replacing it with non-auto business. So how has the response been there? Any progress on getting in the non-auto clients, and what kind of clients are we looking at? Thank you.
Yeah. So on the non-auto side, we have two huge. There are few big brands which we have always spoken about. In the aluminum die casting, 50% of the business is automotive, 50% is non-automotive, approximately. That 50% non-automotive business, we have big names like ABB. We supply to 12, 13 of their plants across the globe, from UK, Germany, USA, Canada, Italy, even in China and India, Bangalore also. We supply to a lot of their full global supplies we have. Endershauser we supply to Switzerland and in Germany. Then Siemens we supply to 3-4 locations. So these are some of the big clients we have on the non-automotive side. So recently we also have some big order from one of the non-automotive client. So it will range into a couple of million euros when it picks up, because there the launch will take 1 year and the annual turnovers will start coming in from 26. So this is one thing which is happening. And also with the existing these plants which we supply to our clients, we supply to multiple plants of multiple countries and multiple plants, and we can increase business with them also once we release capacity from automotive clients. And automotive also, we don't have anything against automotive clients, but we have learnt our lessons, and we want to make sure that we keep a lot of flexibility in the contracts. We don't want to make rigid contracts. We want to have a window open for making price corrections if things like COVID, things like war happens and things go out of some control. That we want to have a window open to renegotiate, because we did business with automotive industry for more than a decade. We never had this problem. Our EBITDAs were 18 to 20% in die casting business also, including automotive, because they were good times. And now these contracts were signed pre-COVID time, and the whole world has changed after COVID. The labor cost, energy cost, inflation, everything went very bad in Europe, and the contract, we were stuck with these contracts, and the customers were not ready to renegotiate because their customers were also not ready to renegotiate, and this is some chain effect we had, and unfortunately this all happened in the last 4 or 5 quarters, and this is reflecting in our overall group performance. If you keep the aluminum die casting outside, we are far above the market what is being delivering. I mean 17 to 18% growth on year-on-year basis on top line, and EBITDA in the similar numbers we have. So, and we know the issues. We have a plan to fix them, and the results have started coming in, and we are very hopeful that this will continue.
Yes, sir. So thank you, sir. This was really helpful. Just the last question was on the metering business. So, the business has been slightly lumpy recently. So, we did around 89-90 crores top line last year, and this year we've done 60 crores. So what could be the reason for this, just for understanding? Thank you.
Yeah. So that's, as I said, some of the export sales have dropped, and it's coming from that gap, and which will be recovering. So we had some big project orders last year, which had helped us, and that's a temporary thing. We are not really worried about metering business, and also we are going to add more into the product basket also there. So a lot of products are also under development, so that will expand our basket so that our market penetration can be much deeper.
Great, sir. Thank you so much. I will get back in the queue.
Yeah. Thank you.
Thank you very much. Participants, you may press star and 1 to ask a question. The next question is from the line of Rahul Dhruv from Pegasus Growth Capital. Please go ahead.
Yeah, hi. So my question was on Rishabh India, and if you look at the overall margins this quarter as well, which are, I think, probably the lowest that we've ever seen, around 12%. I know you did mention some reasons for it, and probably I missed it, but you last quarter as well, you mentioned that it's an 18% business, but again for this quarter as well, we've seen a very, very big decline in margins. Can you explain that?
Yeah. So the Rishabh India business, we have approximately 50% domestic and 50% export. So domestic market gives us good volume, and export market gives us good margin. So that was always helping us in that way. If you look at last year first 2 quarters, we had some big projects with high margins from Spain. So that because of whatever is happening in Europe, those started, they did not happen, but they are coming in the 3rd, 4th quarter, and next year also they will be coming. So that made a big difference to that, but we are recovering. So that margin difference is coming more from where we are selling than what we are selling. So I think that will change the whole scenario. And also in India, also we are trying to revise our pricing strategy and pass on some of the commodity prices which are increasing, like copper and other things increase, so which are used in current transformers, and metal prices went up, which are used in CTs and analog panel meters and all those some of the electromechanical products. So we are trying to pass on those to the customers also through our pricing strategy. So yeah, it's not 18-20, it is more like 15-16, I would say. So this is coming because of the market composition.
So you expect 15 to continue going forward, right?
Yeah, obviously. Yeah.
Okay. And so a little bit on the solar string inverter, if you can, see where we are in the journey, what is the pricing, what are the government contracts like, what is the number actually? I mean, I am just kind of deducting the automation metering from sales to get a basic number, which is around 6.6 crores. I don't know if all of it is inverters, but if you could explain some, give me some numbers on that as well.
Yeah, in solar inverter business, I would say it's not very significant in the whole scheme of things as of now. So we do about it's about 3.3% in terms of the total at a group level. I would say, it's less than 5%. Let's put it this way. So there are two aspects to that. One is, can we sell more? Yes, we can sell more. Do we want to sell more? Is something which we are holding back because there is a lot of Chinese competition. There are dozens of inverter manufacturers, so-called inverter manufacturers. We went to each one of them. None of them make any of those inverters either design or manufacturing. They're just either getting the whole inverter or SKDs from China, where the scale is a big game. And then they are supplying, and to tell you very honestly, the selling prices in the market are close to our net cost. So the conversion is there, and then the profits, etc. So what we have done is we have redesigned the whole product. That's why in my speech also I spoke about this new generation of Neo and Uno inverters, where we have tried to optimize. We want to change this game from making hundreds of inverters to thousands of inverters, and that's possible when we start making them in a mass production. So that's the work which is in progress. I'll give you an example. The whole box or housing which is having these inverters is fabricated and done with 3-4 parts and screwing and all that. Now we are investing in tooling, and we are getting the whole body made along with the heat sink, which is always attached to the backside, in one single piece. I mean, just to give a comparison, Tesla came up with this whole idea of making the whole car in one aluminum casting. Now some of the scooters are also trying to make the whole scooter made in one casting and then build rest of the things around that. So likewise, this is an investment which we are doing now, and this is what we are going to launch in the next year, and then go for not multiple PCBs, one single PCBs, and then go for mass production. So put production lines where the not doing a batch production but a single piece flow production. All these are the things which are in place. Once we have that, then it will be competitive. We can not only sell more, we can make money also out of that. That's where we are kind of little bit scaling it moderately. And once that is done, that I'm expecting to happen in 1 or 2 quarters time, because all the designs are done, prototypes are done, testing is all done. Now we are manufacturing these molds. After that, we have to go through all the certification process for this product. So that takes about 3 to 6 months. After that, this will be full-fledged. This thing we may run even B2C commercials also, where we want to really pull people and start selling more. So we are not given full throttle on the inverters, because there is no point in doing that and making losses. So that's very honest and candid answer to your question.
Thank you very much, sir.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Saumil Shah from Paras Investments. Please go ahead.
Hi, for the opportunity. I wanted to know, for the current quarter, what was the EBITDA margin on the automotive side of aluminum die casting and the non-automotive side?
Yeah, our CFO will give you those numbers. You have them?
Yeah, automotive.
So it is like, I'll give you some comparison also. On the automotive side, last quarter we had minus 24.3% as a EBITDA. This quarter it is dropped to minus 6.4%. Okay, and for non-automotive, last quarter it was minus 2.1. Now it is 1.3. See, what has happened is, when you have the issues in the whole plant, that has a bad effect on automotive business also. By itself, it was very healthy, but because of this influence which we are having on the non-automotive side, all our resources were sucked into solving most of the problems on auto side of the business. And you can see a big difference between auto and non-auto when it comes to the profitability. I hope I have answered your question.
So the line for the participant dropped.
Okay.
Reminder to all the participants, you may press star and one to ask the question. Next question is from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead.
So thank you for the opportunity. Sir, I wanted to understand.
Madhur, your audio is not clear at all. Can I request you to speak through the handset?
Yeah. Is it better right now?
Slightly better.
Yeah. Sir, I wanted to understand what would be our current order book and execution timeline.
Okay. See, the current order book, if you look at, there are two parts to that. One is electrical business. Electrical business, how it works is our conversion to order to book to billing is about 2 weeks to 4 weeks max. So we don't have order.
Sorry to interrupt you. Madhur, can you mute your line while you're not talking, please? Sorry, sir. Go ahead.
Yeah. So this I want to give answer in two parts. One is electrical business. Electrical business, we have our supplies going through few channels. One is through distributor channel, one is through OEM manufacturers like panel builders, etc., and some are for the tenders, etc. So normally our lead time for supplies of these components is anywhere between 2 weeks to 4 weeks is the general time. So essentially our firm order book for electrical business is not more than, I would say, 1 to 3 months. So about 3 months of average sales, you can say, is the order book that we always have. And when it comes to non-automotive businesses, there are contracts signed, and you have much longer visibility, and that is reflecting in our monthly sales turnover. So this is how it works. And what we really monitor and work is on the potential pipeline where we are engaged with the customers, but we have not signed any order. So that's the potential which we work with some probability, and then that gets converted into orders, forecast, and then order on a regular month-by-month basis.
Okay, got it. Sir, also we have mentioned that we have some SCADA software company that we have acquired in FY25. So if you could help us understand who would be the major customers of this software, and what kind of outlook do we have for this segment, and is this integrated into our current electrical offerings, or is this altogether a different thing? So on that front.
Yeah, it's a very good question, because per se the turnover of that company is not huge. So, but it has got a very important and big strategic advantage for us. So this you answered part of the questions, part of your question in your question itself. So this software helps us to promote and sell more of our industrial automation products. So when we are selling products like say power quality analyzers, which are working on MQTT or IoT enabled products, or we have a lot of other process measurement products. So those are transducers. All these products we can have this connectivity, and then this helps us to do a forward integration and value addition. So in a way, what we are trying to have in a long run is that we not only give our products, but we can give a solution, or we can give a design and give a solution to a solution provider. And this software, SCADA software, not only harnesses our products, also it can harness our competitors' products or any other process, anything which is able to push data on the cloud. So it helps in many applications. So this is more for us as a technology center or a center of excellence for this software development, because we have got very experienced software engineers there who can develop the product, design the product, and also do the application side of it. Now this is very new one. The strategy is that this team will empower all our regional sales entities and train them on this product, which may take, because it's not easy product to sell. You have to understand design, understand the customer need, understand our product, design the solution and give it. But a very profitable business. And we will want to use this in two ways. Of course, anybody wants to just buy the software, we can sell the licenses, and some integration company can use this and integrate, design their solutions. Also, our sales team can go and sell our product along with the software, and that's one aspect. And second one is our sales team can sell this along with our product, software, and implementation also. This we do in Poland. So we have possibilities of doing it in other countries also. So this is the way forward for this. It's more like it will help us to sell our high-end products more and keeps our customers bound with our products. Once he has got a software, and most of these products that we have, they will have what they call as a library. To integrating our products into this software ecosystem is much easier. So that keeps our customers bound with us for a longer period. So a lot of advantages with that. And once we have access to this, we can also learn how our products are being used by our customers and acquire all that data, and we can be one step ahead of our competition to improve our products. So all this is all. I mean, we are in a way touching the area of data acquisition, AI, and product development and predictive maintenance, all that stuff. So this is a gateway to go into that direction for us.
Okay, got it. So right now it's in a development phase, or are we selling this product not in India but somewhere in EU or somewhere in other geographies, or it's still in development phase currently?
No, it's a company, because we didn't want to start from scratch. We have acquired a company which is with 35 years of established company in Czech Republic. We are there for 35 years. We have got a dozen engineers who have got experience. The minimum experienced engineer is 15 years and the maximum is 40 years. So it's an experienced R&D team. And before acquiring this company, as Lumel SA, we signed a MOU to work with them. We worked with this product, implemented lots of solutions in Poland, and they have got solutions in Czech Republic, Slovakia, and in some European countries. The product is fantastic. Even in a Siemens plant, they have used Microsys Pronotic SCADA software in place of Siemens software, SCADA software in their plant, because it is in Czech Republic and they see value in that. So it's really good product, but never went global. So with Rishabh platform, we want to take it global and make best out of selling this through our Indian subsidiary. We have got a company called Energy Solutions Lab, which is a small Rishabh subsidiary in India for this activity alone. And we also have a software developed in India, which is by the name Mark. So each one of them have their own advantages. And this is in India, it's about 10-year-old company, which we have tried to develop. And this is a established 35-year-old company in Europe with a lot of experience of providing. They are very good at graphic user interface and have a lot of experience of working in a global stage in many industries. So we will get that technology also in India, use that and give multiple solutions to Indian customers. They can buy Mark or Microsys, this Promotic also. So it opens a lot of opportunities. But we are devising the strategy. All that is in the making. So we just acquired this company. Not much has happened other than people acquainted with that. It's not like selling boxes. It's really some high-end stuff where we need fine engineers to understand and do the application side of it.
Makes sense, sir. So, do we have some kind of a budget that we would like to invest over the next 2 to 3 years? Like, is there a specific amount that we have earmarked for this?
Sorry, again we are losing your audio.
I'm sorry. Is it better right now?
Yes.
Yeah. So I wanted to understand, have we get some budget for this segment, like how much we would like to invest over the next 2 to 3 years?
We have investment budgets for the company, overall group, over the next few years, and we keep on allocating these budgets based on the product development need that we have, and we take this call every budget year. So definitely when we are building because when we built the last budget, we didn't have microcysts in place. Now with the microcysts now in place, definitely there will be some allocation for the development. First, it's a developed product. First, we want to invest into, marketing this product, taking this product to the global platform, training of our existing teams, and then they have to take it to the market. And after that, if there is further development needed with this product, we can do that. Now our investment will be to expand and reach with this product to the whole our internal resources. We have to take this to STI UK. We have to take it to all the Lumel area sales offices, Rishabh team in India, and then they can take it to the customer. That's what is going to happen in the first phase.
Got it. So there's a final question from my side. So if I look at our company on an overall basis over the next 2 to 3 years, so what kind of revenue and revenue growth as well as margin can we expect, considering these automotive, the alucas issues go away, or so over the next 2 to 3 years, what kind of margin trajectory as well as revenue trajectory can we see on our business?
Yeah. So that I want to answer again in 2 parts. One is electrical and electrical business. Electrical business, we can expect a trajectory of 18 to 20% on the top line, and a bit of 17 to 20%, that band. So that's what we can expect, and we are doing that more or less now, and that will continue. So there is absolutely no problems on that side. On the automotive side, we were on a very high ride of 20+% year-on-year revenue sales. That we will curtail. So you can expect that we'll remain flat on the aluminum die casting side for 1 or 2 years until we repair our profitability, which is a work in progress. Once we do that, then we'll scale it up. So I can say that you can expect a flattish revenues in the next couple of years for aluminum die casting, and after that we will ramp it up. In the next couple of years, we will try to get our EBITDAs first to a single digit, then about 15% to 17% EBITDA we will try to get on the die casting business, and then after that we will be focusing on further growth.
Okay, got it. So thank you so much and all the best.
Yeah, thank you.
Thank you very much. Next question is from the line of Pratik Giri from Sublab Research. Please go ahead.
Hi, am I audible?
Yeah, I can.
Hi, Mr. Muslikar. Congratulations on the turnaround. Most of my questions are answered. I just wanted to understand, is the worst behind us in terms for our aluminum die casting business, or I understand, these things takes time. So, should we expect one more quarter for the lagging effect to be there?
So I kind of try to cover that. It's very very good questions and also very difficult question because we want to say that the worst is behind. I kind of almost feel that way, but we don't want to give any unreasonable hopes on that, because we want to be very transparent with this, because these contracts which we have are still going on, and we have made price corrections, so they are being sold at a higher prices also. But that market is really very turbulent now. The automotive industry in Europe is very turbulent with whatever we see now, and I can see for the next few quarters. In 1 or 2 quarters, we should be good, sustainable, and we can say worst is over. So that's what I strongly feel and want to believe on that. But if the things are like now with Trump in place, so many different things are coming on a daily basis, and we don't know what is going to happen with the Ukraine war, which we were expecting after Trump comes, the war will be over in a week's time or something. It's a lot of things are going on at a geopolitical level. So barring those unexpected things, we can say the worst is behind us.
Point taken, sir. Answer totally understandable. Sir, I wanted to understand, as you have alluded to the European automobile market, there has been talks around probably import duty on Chinese vehicles as well. So in that case, do you think that our aluminum die casting business, particularly for the automobile part of it, can give us better margins? I mean, as good as the non-automotive part of it, if it happens?
See, it's the thing is they are expecting the import tariffs they are talking, and even if the import tariffs are introduced, the gap between cost of manufacturing of Chinese and the local manufacturing is really really huge. So and that is possible. That has happened because Chinese started and believed in electrical cars more than 10 years ago, and they were really onto it. So to that extent, the whole world is at some disadvantage, and particularly Europe, where the cost of labor has increased substantially. Inflation has been double digit in many parts of Europe for last 2-3 years, and which used to be a stable environment with inflation of 2-3%, growth also 2-3%. Everything was stable. Energy costs were also stable. That was known to be very stable continent, matured, and that's all shaken up. So with that, even if with the import duties, I do not know how much of cost advantage the local manufacturers will have. It's similar to what we see in India for example, our inverter business. There is a 20% import duty on the inverters. After import duty also, their landed cost is lower than our net cost. So it's just the scalability, or they are funded by government in China to dump the products in every part of the world. So China is kind of a bit of a mystery when it comes to the cost, because the components are the same. I mean, we can talk about scalability, but I think it is more than scalability. It is the government policies which are also a part of this equation.
Well explained, sir. That's very helpful. Just last one. Sir, with this renewed contracts with automobile players, for the die casting business, will it be possible for us to say, 3-4 years down the line, transforming this business entirely in the favor of non-auto sector? I mean, the ABB and the Siemens of the world, which you mentioned. The current contracts, do they allow us, not immediately, but at least 3-4 years down the line?
Yeah. So we have the biggest customer. We have already concluded it in about 12 months time. So after 12 months, it is our prerogative whether we want to continue or not. So that is possible. And with another major die casting, automotive customer, the contract is open. But I think we have that possibility. So to tell you very honestly, sir, about 10 years ago, our turnover in aluminum die casting, I went there in 2014, 13 end. So it's almost like 11 years. Our turnover was 1/3 of what we have now. And we were at a, kind of break-even kind of a thing. And we had 100% non-automotive business. And then I started automotive business after going there. And we had significant growth of almost 3 times. And the EBITDA we achieved in those years were anywhere between 16 to 19%. I mean, if you look at most of those years before COVID, and that has propelled us to grow significantly. And the idea behind that was to diversify our portfolio into different segments, because automotive started going so high. At some point of time, we grew this business so much it became 70% of our portfolio. And then today we have brought it down to around 45%. Around 45% we have brought it down now because of all this turbulence which has happened. So ideally for me, I would still like to have 30% of automotive business, but very comfortable contracts and profitable business, and ability to walk away or ability to renegotiate. That's what is our intention, because these industries, depending on it, just spreading our risk across the industry and across the customers. That's part of our strategy. That is what had started this whole automotive journey, and we had very good run with that. So things have been going south in the last few quarters, and we hope that we'll get back to stability.
Understood, sir. Very, very well explained. Sir, those are my questions. Congratulations once again, and good luck for the future.
Thank you. Thank you very much, sir.
Thank you very much. Ladies and gentlemen, we'll take that as our last question. I'll now hand the conference over to the management for closing comments.
Yeah, on behalf of all our group companies and the management team, as well as all our employees, I would like to thank all our existing investors and potential investors to continue to show faith in us. And we were going through a lot of turbulent phase, and which we feel that it is almost getting over. But we really appreciate people who have been with us throughout this, and we hope to create value for our shareholders in the coming quarters and coming years. Thank you very much.
Thank you.
Thank you very much.